Hello everyone, my name is Crystal Moore, VP of Professional Development here at ACCE. Thank you for joining today's webinar, Got UBIT. Today's speaker is Karen Grice, CPA Principal of Clifton Larson Allen LLP. And before I turn it over to Karen, I would like to just briefly let you know about some housekeeping notes. Please mute your phones. Please do not put us on hold. There are two ways to ask a question. You can use the chat box in your panel to the right, or you can raise your hand by clicking your name, and it'll show that your hand is up, and we'll call on you, and that will activate the audio. Karen has agreed to take questions throughout the presentation or at the end. If it is appropriate, I will read your question out to Karen during her presentation. Karen, I'll turn it over to you. Why don't you start by telling us a little bit about yourself?
Okay, thank you very much. Well, first of all, thank you for the opportunity to speak to the group and talk about unrelated business income. I know for many of you it might be actually a topic that you address once a year. For some of us, such as myself within the firm, I'm a principal with Clifton Larson Allen, who actually serves our not-for-profit sector, providing tax compliance and consulting to our exempt organization clients. So when you talk unrelated business income, if we're doing planning, assisting with computations, really deciding that correct treatment and taxability of UBI, this is actually a topic that's near and dear to my heart as I've talked to the organization. And I think it's a topic that there's a lot of confusion within the exempt organization sector. We all want to do the right thing by way of the filing of our 990s and our 990T, but it's not always easy to get your arms around those activities. So the presentation today, titled Got UBIT, is really going to address unrelated business income tax and talk about from a very, hopefully ground level, grounded in the details, information that you can walk away with and really apply within your own organization. We'll talk about some examples of UBI that I think we commonly see within our chambers of commerce that we work with throughout the nation, and then also maybe some other issues that it may or may not be something that you find relevant. As was indicated, if you have questions, by all means, interrupt as we go, because we want this to be as interactive as possible, as interactive as we can, being on a webcast. So with that being said, we'll start out with just some basic unrelated business income 101. The purpose of UBI, or unrelated business income tax, the UBIT aspect of it, is really for exempt organizations that have earned revenue. And it's revenue sources from business activities or activities that you're conducting that really don't further, or they're not related to your organization's exempt purpose. And the unrelated business income tax scheme is truly to impose a tax on those net profits. So it's your revenue less your expenses. So you're paying taxes if your corporation has a corporate tax rate. So it's really a level playing field between you as an exempt organization and maybe another for-profit entity that may conduct similar types of activities. So that's really the purpose of the unrelated business income tax. And it is the case that we'll talk a lot, it would be concerning federal tax. We'll talk about the 990T just briefly, but it also may be applicable as far as state and local taxes that may also be imposed upon the unrelated business income. So just knowing the requirements, when we talk again, Nonprofit 101 UBIT, is knowing those basic requirements that are placed upon you as an exempt organization. To even have unrelated business income, you have to really meet a three-pronged test, and it's an all-inclusive three-pronged test. It has to be a trade or business that's regularly carried on, and the activity itself is not substantially related to your tax-exempt mission or your exempt purpose. So, and again, keep in mind, as I said, there's an and that connects all three of those items. So perhaps you are operating a trade or business, but it's something that's not regularly carried on. It's only conducted once a year. Maybe that's enough to say it's not going to be UBI. Or maybe it's something that you do regularly, but it's not a trade or business. So again, there's different ways to look at this unrelated business income question And it's necessary to, so to speak, crack the nut to say whether or not we have UBI and whether there's a tax filing requirement placed upon the organization. For many of our chambers, one of the most common forms of unrelated business income that we see within those entities one of the common forms of revenue that we see within the organizations are truly qualified sponsorship payments. We'll just refer to them as QSPs just for short. A qualified sponsorship payment is really a payment for which, and I use the term in this slide, a donor. Maybe I should have used a payer or an entity, but it's really a payment coming from somebody outside of your organization where that individual or company or payer does not really receive or expect to receive any substantial return benefits. So maybe if you keep that terminology handy, because we're going to talk about that in a little bit, but the individual does not expect any substantial return benefit except perhaps the fact that you will allow that entity, that organization, to use them, their name, their logo, product information in a sponsorship acknowledgement. So again, that's the only return that they're anticipating. Qualified sponsorship payments themselves, QSPs, are tax exempt. They don't give rise to unrelated business income. They're totally excluded from the calculation. What's interesting to note is the fact that a qualified sponsorship acknowledgement itself is tax exempt, but if we cross that line, and what you're providing to that sponsor in exchange for the payment is actually advertising, generally advertising itself is taxable as unrelated business income. Now we're talking about advertising right now in the context of a qualified sponsorship payment, but it might be advertising in your directory, the Chamber's directory that lists out your members. It may be advertising in a few events that you have. It might be advertising in your newsletter. So keep in mind that advertising itself, again, is generally classified as unrelated business income. So back to our qualified sponsorship payments. It's somewhat irrelevant. It doesn't matter whether the activity that's being conducted is related or unrelated to an organization's exempt purpose. The payment itself is still going to be classified as a qualified sponsorship payment. It's still going to be a payment coming from a sponsor. There are a few caveats just to know that if that advertising or sponsorship is done within, as I said just a moment ago, your Chamber's newsletter or your Chamber's publication, that is an exploited activity. So it really doesn't change the context of that activity. Even though the publication itself is related to your exempt function, if you have advertising contained within that publication, that does give rise to unrelated business income. It's important to note also that a qualified sponsorship payment itself cannot be, the payment be contingent upon a level of attendance at an event, or that too can taint the payment and basically say it's not a sponsorship, that is unrelated business income. Now, if a payment is a combination of their substantial return benefits or other types of benefits that are pulled together in your overall sponsorship package, it's not uncommon that as part of a sponsorship package, I might be attending the annual meeting or an annual gathering of your chamber, and included in that sponsorship package are various benefits. Some of the benefits may be disregarded if it happens to be an acknowledgement. I may receive advertising. I may have a table or two at the annual meeting. Well, it's necessary to look at that sponsorship payment and really allocate a value to the various benefits that are provided to that payer. So again, the payer knows how to treat it for their own tax purposes. But more importantly, when you're completing the Form 990 for your chamber, and or you're looking at whether or not you have a 990T filing requirement, you'll know which, I'll use the term bucket, that revenue needs to be placed in as you're putting that return together. When we talk in terms of substantial return benefit, substantial return benefit, and these are the items that you have to make an allocation of that sponsorship payment. You make an allocation to these various benefits. It would include advertising. If there are any exclusive provider arrangements, if you are providing goods or services in exchange for that sponsorship payment, or if there are other certain privileges that are valued, that would be deemed to be substantial return benefit. So you are required to go through an allocation of determining of that sponsorship payment what is deemed to be substantial return benefit versus what other items of value are included as part of that sponsorship agreement, but perhaps you are not required to value, or they don't fall succinctly within the buckets. What other items of value do you have that may be intangible in nature or don't fit within those parameters? In exchange for a sponsorship payment, the IRS or regulations are very clear to indicate that a substantial return benefit doesn't include an acknowledgement. So if you are providing an acknowledgement to those companies that are sponsoring your activity, as the chamber, you can recognize the sponsor by including that organization's name and logo as part of the promotional piece. I'm not going to call it advertising. I'll call it a promotional piece. We won't use that A word. But as part of that promotional piece, you're providing the sponsor's name and logo. Perhaps there are slogans that are part of the sponsor's identity, but again, they don't contain qualitative or comparative descriptions. I many times will use as an example GE, General Electric. We bring good things to light. You know, that is a known slogan that's part of the sponsor's identity. So if you have a sponsorship acknowledgement and you have GE's name and logo and a slogan such as that, that is allowed to be in that acknowledgement. And again, there's no qualitative or comparative language associated with that. If you have, it would be a listing of your sponsors, locations, telephone numbers, internet addresses, all of which is allowed. You can provide that as a benefit to your sponsor as part of that sponsorship acknowledgement. If you have value-neutral descriptions of the sponsor, or you may include the sponsor's brand or trade names, product listings, that is all deemed to be items that are excluded from that definition of a substantial return benefit. If you do have a golf outing, excuse me, if you have a golf outing, and maybe your sponsor is at your golf outing, you can display or distribute your sponsor's products at the event. That within itself is not something that's going to taint the sponsorship payment at all. So again, it's still a disregarded benefit when we look at the evaluation. Sometimes in exchange for the sponsorship payment, organizations will provide a hyperlink or a link on your website that'll link to the website of the sponsor. Now, as long as in exchange for that sponsorship payment, the link from your website is going to a home page of the sponsor, that within itself also is allowed, and it's not deemed to be a substantial return benefit. It's just another way that you are providing an acknowledgement to your sponsor. But it's very important that that hyperlink goes from your web page to the sponsor's home page, that it doesn't go directly to a sales page. The IRS has interpreted the fact that if it goes directly from your page to a sales page of that sponsor, that many times constitutes unrelated business income. So it's not enough if you're sitting as perhaps the CEO or executive of the chamber, if you're a board member, maybe the people on the call are actually part of the finance area within the chamber. You really have to know what is being provided to those sponsors so you know how it will be treated from an income tax perspective. There is a de minimis exception. Basically, the IRS has indicated, or regulations indicate, that if the value of all of the benefits that are provided to the sponsor in exchange for that payment do not the value of those are less than 2% of the amount of the sponsor's payment, all of the benefits that you provide to that sponsor may be disregarded for the purpose of determining substantial return benefit. And really what that requires is incumbent upon you as the organization conducting this activity to determine the value of those benefits or promotions that are provided to the sponsor in exchange for those payments as part of that overall sponsorship package. So for example, maybe what we have is we have the Chamber's annual golf outing that occurs every year. And as part of that outing, one of your members pays $1,000 to sponsor the golf event. In exchange for that $1,000 payment, there is the golf that the individual or that a group of individuals receive. So maybe the value of that golf or the holes of golf is $500. Maybe they have a table at the evening event, which is another $200 of value. Again, looking at fair market value of the evening. And then maybe the advertising is actually valued at $100. So there is some advertising associated with that event. So what we have is a $1,000 payment that's made to the charity or to the chamber to sponsor that golf event. But when we add up the benefit of the golf, the meals, that table at the event, plus the advertising, the $500 for the golf, the $200 for the meals, and then the $100 of advertising, it's really $800 of benefit that's provided to that payor or your chamber member that sponsored the event. And really, it was a $1,000 payment, and 2% of that $1,000 is actually $20. So the $800 of benefit exceeds the $20 that you were allowed to provide. So in that example, you are required to value that substantial return benefit and provide the information back to, again, the payer, so they know how to treat it for their own income tax purposes. But then you also will know that of that $1,000 that you received, $200 of it went towards the meal. Maybe it was a gala that you had after the golf outing. $500 was the golf event, and another $100 was advertising revenue that may or not be subject to unrelated business income tax. If we take that payment one step further, let's say the payment itself was a $10,000 payment. And in exchange for that, the person received $100 worth of $100 of value, again, tickets at the evening meal after the event. Well, if it's a $10,000 payment, 2% of the $10,000 is actually $200. The value of those meals were $100. You're not required to go through the valuation of those items because, again, the 2% is greater than the value that you provided back to the payer, so it may be totally disregarded for sponsorship acknowledgement purposes. So again, you really have to get your arms around what is being conducted with the activity, what is being provided to the sponsors so that you can make the determination of what do you have to value, do you have to go through those computations. We'll talk a little bit, if I may, about advertising. Advertising itself, for the purpose of qualified sponsorship payments and even for other purposes, is always deemed to be a substantial return benefit. So if you are providing advertising in exchange for a sponsorship payment, that DeMinimis calculation we just went through, you'll have to disregard that. And it's treated as unrelated business income. But it's really important you understand and look at those promotional pieces. Again, I'm not using the advertising word, but you look at those promotional pieces that are provided to the sponsor in exchange for the payment so that you do know whether or not the chamber is providing back to the sponsor an advertisement or is it merely an acknowledgement of that qualified sponsorship payment. An advertisement itself will contain qualitative or comparative language. If you look at that promotional piece, or you go to many magazines or the newspaper, if there's qualitative or comparative language, it would be an advertisement, because again, an acknowledgement of a sponsorship payment cannot contain that type of language. If there's price information or an indication of savings or value, it will be an advertisement. So if a sponsor puts in your directory language that says, bring in the directory for a 10% discount at our location, that within itself would deem to be, again, price information or an indication of savings, so it would be taxable as advertising, I should say. If the chamber is providing endorsements, that too crosses the line from being a value neutral or a neutral sponsorship acknowledgement, and it may be taxable as advertisements. And again, inducements to buy. So my earlier example, if I basically said bring in the program ad or the program directory, and you will receive a free XYZ, or bring it in for a discount, that within itself is an inducement to buy. So again, value neutral language is fine. Use of the sponsor's name and logo, website address, phone numbers, locations, products, trade names, trade logos, anything such as that is allowed. But you cross the line into advertising where you're not just a neutral sponsorship acknowledgement. That's when we many times will generate taxable advertising that would be appropriate to be taxed on a 990T. When we look at, advertising versus sponsorship agreements, there's many times where our firm, maybe it's in the course of an audit of the organization's financial records, or perhaps it's in the course of our tax preparation, where we do begin the process of looking at, or we look at those sponsorship agreements. And that's really where we've gathered perhaps our own, I'll use the word insight, as far as what are some takeaways that we've seen as we've tried to help clients, really navigate through advertising versus sponsorship agreements. One of the items to keep in mind if you do have sponsorship agreements is to make certain that in the agreement itself, to designate the type of payment and the correct type of payment, and use the appropriate language within the agreement. If the payment is anticipated that it will be a corporate sponsorship payment, then the language should talk about the sponsorship. It should talk about the acknowledgement. It shouldn't really talk about the advertising. I've seen many agreements where the agreement is a corporate sponsorship agreement or it's a sponsorship agreement, and one of the first items or lines in this agreement, it will talk about, in exchange for your payment, you will receive advertising of X. But yet, when we go back and look at the promotional pieces that are provided to that payor, those promotional pieces themselves mirror a sponsorship. It's not an advertisement. But yet in our agreement, we're really mixing apples and oranges. We're talking about the sponsorship and the sponsorship payment, but then we're using the language of advertising. So again, being consistent. It's important to, again, the fair market value of all benefits received should be noted, perhaps just right in the agreement or as an addendum to the agreement, so that it is clear and upfront that there has been a designation of determining how much of that sponsorship payment did the payor receive back in the form of benefits. I've had situations where in exchange for a sponsorship payment that the donor, I use the term, or the sponsor may decline any of the benefits. And if the benefits themselves are declined up front, there's no value attached to those because, again, the sponsor did not receive anything in exchange for the payment. But if the sponsor comes back to the chamber after the fact and says, I wasn't able to attend the event, so could you change my acknowledgement to indicate that I receive no substantial return benefit? Your answer is no, because in order to disregard those benefits, you either have to fall below the threshold or they must be declined up front. The other item to keep in mind when you are looking at your sponsorship agreements is your organization should retain that editorial discretion or control over all sponsorship acknowledgments. If it happens to be an acknowledgement that's placed on your website, an acknowledgement that goes perhaps into your newsletter or publication or your member directory, you want to have that appropriate control to know that if it's not your intention that this promotional piece will cross the line and really turn into taxable advertising, you want to make certain you have that ability up front to make that determination and really to be able to approve whether or not that promotional piece is crossing the line. So again, having that editorial discretion right within your agreement allows you in advance to make the determination of who will make the final call, we'll say, as to whether or not this is advertising or a sponsorship acknowledgement before your publication goes to print or the promotional piece ends up on your website. Many of our chambers also have, should I say, annual meetings or trade shows or a type of conference. And I really wanted to call out this exception that's really afforded to C4, 3, 4, 5, and 6 organizations with chambers as a 501c6, is if you do hold a convention, a trade show, or an annual meeting, and really the purpose of it is to bring your people together to further the industry or to further the business nature of the organizations, and there may be an educational component attached to it, along with other types of benefits that really is promoting the group, that within itself is excluded from unrelated business income. So if you are, in essence, collecting, should I use the word registrations? If you are having trade show activities, so maybe it's booth rentals and other types of revenue that you're collecting, that revenue within itself from a qualified convention and trade show is not going to be taxed as unrelated business income. So if you are conducting those activities, just make certain we're not putting them on an I-90T, and know that you can continue to conduct those activities in a manner that's not going to generate unrelated business income. Many of our chambers also will enter into royalty agreements with members or other outside vendors. And generally, royalties themselves are not taxable if they are structured appropriately, if they're properly structured. In determining whether or not an exempt organization, or in this case the chamber, is exempt from taxability from those royalty payments, it's important that you as an organization remain passive versus active in generating that income. Some common forms of royalties that we do see is perhaps there is a type of affinity card, a credit card that's offered that has your chamber's logo, name, logo on it. And that within itself, you're not doing anything to generate that revenue except providing the names of your members to another company, and in exchange for that, maybe based on the number of organizations or individuals that sign up for the product, you will get a royalty paid back to you. That within itself, again, as long as you're passive, you're not active in, should I say, providing other than just maybe minimal services, if any at all, under the agreement, it typically will be a revenue stream that will be not taxable to you, so it won't be classified as unrelated business income. What's happening now, though, in today's world is the IRS is more actively challenging that determination of active versus passive when we look at the posturing of unrelated business income. So again, if you have royalty streams coming in, just a word of caution would be look at those agreements. Make certain you're understanding completely what is being rendered or how that revenue is earned, and whether or not you are active in earning that revenue. Because again, you cross that line out of being passive and you start going down that path of being active, you could be looking at unrelated business income, or I should say you more likely than not are looking at unrelated business income. Many times, a royalty itself is the right to use that intangible asset. So maybe it is the logo of the chamber. Maybe it's the intangible mailing list. You're providing that to another organization and you receive something back, the payment back in return. And again, a minimal amount of services may be allowed when we look at royalties and not really cross that line into an active taxable event versus a passive royalty. Services such as updating your mailing list for new members and providing a revised mailing list to that company is not something that will typically taint that royalty. But if you are the organization that's out marketing to all of your members on behalf of the organization that will give you a royalty payment, that is perhaps crossing the line, because you are now actively promoting another organization's trade or business versus it just being a passive royalty. There are cases where perhaps the language, again, very similar to the corporate sponsorship agreements that I was talking about earlier, there are cases where perhaps the agreement itself doesn't truly reflect the operations or what's being done under the agreement. So it's really very important that, just as we talked about with your sponsorship agreements, that you're truly looking at the language within your royalty agreements to make certain that you are, in essence, doing what you said you were going to do, or not doing what you said you were not going to do under the agreement. For example, we had one organization go through an IRS examination. And what was, in essence, challenged on the examination was the fact that the client, the organization, indicated they were not active in generating that revenue. But when you look at the sponsor or the royalty agreement itself, it indicated that the exempt organization was, in essence, to provide services under the agreement. They retained many forms of editorial control along with other types of control, and that was enough to really push it into a taxable, active trade or business versus just a passive royalty stream that's coming back to the organization. If you have royalty agreements where what you are looking at is a royalty agreement and perhaps a service component, perhaps you want to consider separate agreements. Is the royalty agreement itself will cover the non-taxable passive income, but if you are also rendering services under that agreement, perhaps it's a separate agreement and you assign a value to that agreement. So again, down the road, if it's ever questioned, it's very clearly delineated within two separate agreements what is the tax-free royalty versus what is the taxable portion that would belong on a 990T and be taxed as unrelated business income. I also wanted to mention that it's not uncommon that perhaps many of our clients may have multiple organizations. Maybe it's an entity where you have the chamber, but then there might be a foundation. Maybe there happens to be a PAC, a political action committee, associated with your chamber. Maybe there also happens to be a C4 advocacy organization that's associated with your chamber. All very common that we see within our organizations. The IRS does have a carve-out to indicate that if there are payments between controlled entities, certain types of payments are treated as unrelated business income to the extent that they may reduce the net income of a controlled organization. So if you have a taxable for-profit entity as one of your subsidiaries, and let's say that there happens to be a loan between the two organizations, and that taxable entity is paying interest to the chamber, the tax exempt. That interest, or if it happens to be a royalty, or if it happens to be rent, that within itself would be deemed unrelated business income and taxable to the chamber. When we look at the control, we really look at, do you own or have control of more than 50% interest in that other organization? And that's just very simply put. But again, it's very important that you really understand the type of relationship and the types of activities that are conducted so you can determine whether or not that revenue is going to be taxed as unrelated business income. If that income within the other entity that's being paid to the chamber, if the activity that's conducted within that subsidiary is an activity that would be exempt, if the chamber itself were conducting the activity, the income is not deemed to be unrelated business income. But if it's something unrelated to your mission, then that would be taxable as UBI. For example, maybe you have some type of summer celebration, and there's a summer celebration by way of a music festival that is conducted within your community. The chamber takes the lead and is really coordinating that event, and it's a chamber's event. But as it turns out, is this summer celebration, what's conducted in that subsidiary would be all of the advertising that's collected as part of that annual event. Whereas the other types of payments, the payments for the tickets, perhaps sponsorships, and other types of non-taxable activities are actually conducted within the chamber. If you had loans between the two organizations and that taxable organization that is conducting the advertising activities pays interest to the chamber, that's going to be classified as unrelated business income. If we're looking at other types of activities being conducted within that exempt, that's fine as long as they're exempt function activities. That exempt organization, your chamber, may also be conducting activities that will be taxable on a 990T. And if that is the case, the chamber will have its own income tax filing in addition to that for-profit subsidiary that's conducting the summer festival, that organization will also file their own income tax filing and pay taxes on that type of activity. So again, it's really understanding the rules as it relates to controlled organizations. You know whether or not you have a controlled entity, but getting your arms around whether or not any of those payments that are going between the subsidiary and the chamber could possibly constitute unrelated business income for the chamber. Another item I wanted to mention, and it perhaps is not right on point as far as unrelated business income, but I wanted to provide information concerning what we call quid pro quo. And it maybe isn't right on point as far as being applicable to a chamber as a 501c6 organization, but even as a C6 and not a C3 who's eligible to receive tax-deductible charitable contributions that we typically think of when we talk quid pro quo. But when an organization, in this case a 501c3, does receive a payment of $75 or more, and in exchange for that payment, the person who provided the payment to this charitable organization receives a benefit, the organization is required, just as you are under the corporate sponsorship regulations, quid pro quo rules say you must, again, value that benefit and provide that information back to the payer so they can make a determination of whether or not any of that payment may be deductible as a charitable contribution if the payment's going to a 501c3. So maybe it's going to the chamber's foundation, the charitable arm of the chamber. And this commonly applies to our foundations or other types of charitable organizations where perhaps we're conducting silent auctions or other types of fundraising events. So again, the quid pro quo rules aren't giving rise to unrelated business income, but just another filing requirement that the organization would have. And it's important to note that if you do fail to provide the appropriate disclosures to organizations or individuals that are making the payments to you, it is a penalty of $50 per occurrence that the IRS may charge. And it may result in that contribution being disallowed to the donor, depending on the value or the dollar amount involved. So again, I merely mentioned the quid pro quo rules whenever we are in the course of discussions concerning unrelated business income, if it's compensation reporting, if it's during the preparation of the 990, which I'm sure many of you are knee-deep in getting your own return done by the November 15th deadline. It's just a good time to remind organizations of this requirement also, especially as we go into holiday season. We do end up with additional fundraising events. So again, merely wanted to mention that, even though it doesn't apply directly to unrelated business income. In closing, perhaps before we get to any questions that any of the participants or people on the call may have, I wanted to mention the fact that the unrelated business income scheme would basically indicate that when your revenue is $1,000 or more is when you actually do have to file a 990T, and there may be a state counterpart to that unrelated business income filing. So your state or local jurisdiction may also require a filing to be had. If you have unrelated business income, and if that total UBI is valued appropriately and is below that $1,000, there actually is no filing that is required upon you as an organization. It's just merely keeping the appropriate documentation so you have that information in your file should you're ever audited or any regulator comes in and looks at the UBI activity, so you can really constitute or prove the fact that there's no filing requirement. The other item I wanted to mention, I think at the beginning we talked about, it's the net unrelated business income that's taxable on a 990T or by the state. You look at your gross income that's generated from that activity and really subtract out any expenses that are really generated as part of that revenue. So they are expenses, those unnecessary expenses that come about because of that unrelated business income activity. Those are what you can deduct against that revenue to really result in the net that would be taxable as UBI. So with that being said, it ends, I'll say, just the presentation portion of unrelated business income, just a brief overview, talking about a few common areas of UBI, qualified sponsorship payments, royalties, talking a little bit about controlled entities, circling back with filing requirements, and I'd really like to leave it open, if I may, at the end, the last 15 minutes, if there are any questions. As we were putting the program together, we talked about having about 45 minutes of presentation and then allowing enough time to answer any questions that may come about. So with that, I'll turn the floor over.
Okay, thank you so much, Karen, for all of that information. At this time, if you'd like to send a question in the form of a chat, please feel free to do so in the chat box in the panel on the right side of your screen, or you can raise your hand and we can call on you for an audio question by also using the panel on the right side of your screen. And Karen, I did not get many questions during your presentation, and it does not look like we have many questions from the audience. Do you have can you put up your contact information in case they want to contact you directly?
Yes, most definitely. There on this final slide is my contact information, and I do leave it open that if you have any questions whatsoever, please feel free to email or call, and I'll assist in any way possible. If you just want to talk through, bounce a question, whatever it may be, always available to answer.
Okay, Karen, it looks like I did get some. Okay, the first one is, what type of expenses are eligible to offset UBI for 990T purposes?
Well, the types of expenses that you really offset the revenue or offset against the revenue would depend on the type of activity that's being conducted. So again, if it happens to be advertising, you may have your direct cost of solicitation of that advertising. You may have typesetting and other direct costs of getting that promotional piece ready. Those may be some of the direct costs. There may be a sales force or an individual on staff that is associated with generating that advertising revenue. It may be even some of the time within the finance department to collect the money, to deposit the funds, to go through the allocations, to determine, how do we allocate our expenses. All of that would be allowed and deductible against the revenue. It's really a matter of looking at that activity, no matter what it is, and making the determination of what are our direct expenses, and making certain that those expenses that you would not incur if it were not for the the unrelated business income activity, you would not have, deduct those. And then the next step would be looking at all of the indirect expenses. Tax preparation fees is another expense that you could offset unrelated business income. For the purpose of the presentation, I didn't really want to get too deep in as far as the advertising is concerned, but if it happens to be a publication that you're mailing out and the publication has advertising included in there, you may be required to pick up a portion of your dues income as additional circulation income, but then your circulation expenses, such as printing your publication, mailing your publication, those two, you can go through the computation and take a portion of those expenses to perhaps offset the unrelated business income.
Okay. The only other statement, I think this is more of a statement than a question, Karen. I'm just going to read through it and you tell me if it makes sense or not. White labeled website that generates revenue to the COFC, consumers buy products and COFC get a royalty.
Okay, could I have you repeat that one more time?
It says white labeled website that generates revenue to the COFC, consumers buy products and COFC get royalty. That is from David.
It is very possible that depending on how it is conducted, you may be generating a royalty off of your website versus other types of revenue. I'm almost in a position where I'd want to make certain I completely understand what is being done and what is being provided in exchange for that. I know we have situations where many of our clients are, in essence, within their website, there might be certain clicks, depending on the visitors to your website and how many times they click a sponsor, you may receive a royalty payment in exchange for the number of clicks through your website. So it's possible that it could be an activity such as that that's being conducted. So without knowing specifics, it's hard to comment on that statement. I know, especially when you're starting web activities, what we've seen a year ago, what we see today, and what we're seeing tomorrow, those web activities are becoming so sophisticated and developing so quickly that the sky's the limit when you look at the creativity of what's being done.
So David, I'll ask you to email Karen directly if you need more a better explanation, or if it did not answer your question, you can contact her at the contact information on the screen. And it looks like, Karen, that is all of our questions. Again, thank you so much for doing this for us today. The presentation will be made available shortly after the event in a couple of days, and feel free to contact Karen with any questions you may have.
Thank you very much. Have a great day.
Thanks, Karen. Have a great
Bye
day.
now.
All right, bye-bye.